we're going to set up a calendar here going to 160. So we're going to set a calendar targeting that 160 strike. That's where we think initially it's going to go, and then it could go higher, but we think initially it's going to go to 160, probably stay there, maybe hover, could come back off a little bit. So it could take time, but eventually we think it's going to break and go higher. So we can trade this with first starting out with a calendar, and then we can do this into a lot of different things. Calendar diagonal, we can adjust these to butterflies, debit spreads, all kinds of good stuff. So here's what it would look like. So we go out in this example. I typically like to go, you can go out as far out as you want, but typically I'll look at something like at least 20 days, 15 days out. So let's say we go out to and we buy the 16 April series, 20 days out. So we're going to buy a long dated here. So we're going to target 160. So I go out here and I can buy the 160 strike here, that call. So that's going to cost maybe $2, $200. And then I'm going to sell against it the 24 series closer in, and you sell the same strike. So I'm going to sell the 160 there, and you're going to bring in 20, 30 cents or so for selling that 160. You're going to bring in about 65 for that. All right, so that's going to end up looking like this. Okay, so you want to go out, play that duration time frame. So we're going to buy the 6 April 160 strike. We're targeting 160, and then we're going to sell against it the 24 series, next week's expiration 160, bring in $70. So we just created this calendar. So this cost here is 205 less your premium brought in 70. So this is $135 debit cost or risk. So this trade is a total risk of 135. So that's your max, potential risk on the trade. So it costs us 205 for the long dated, and then we sold against it the 160 here brought in 70. Okay, so the total cost of the trade is your spread of 135. All right, so that's the max risk. Now, if it was to hit your 160 at expiration, this is what we're looking at our risk reward to see if we like the trade. This right here, if we hit that expiration at next Friday at the 24th, it hits 160 and it goes out there, this would make about right here about $215. So right there, kind of like a butterfly. So you make $215. So your potential profit, you've got a potential to make $215 on your risk of 135. And your risk of 135, so that's like 160% return. All right, so but if it doesn't go out there, you're still making pretty good money in this area here. Plus, if we wanted to, we don't have to get rid of the 160. We're out there 19, 20 days out. We can keep it and like a covered call, do it again over and over.